What's in your wallet? Cash, cards, maybe a digital wallet on your phone. For something we use every day, it's amazing how little most of us think about what money actually is. Today, we're going to take a lightning-fast journey through the entire history of money, from ancient shells to digital currencies, and discover how what we call value has never stayed the same. Before money existed, there was barter. I'll trade you this goat for that basket of grain. Simple, right? Except what if I want your grain, but you don't want my goat? This problem led ancient civilizations to develop commodity money objects with inherent value that most people would accept in trade. Cowry shells in Africa and Asia, salt in Ethiopia, cacao beans in Mesoamerica. These natural items became the world's first currencies around 3000 BCE. But they had problems. They could rot, break, or in the case of salt, dissolve in the rain. The world needed something more durable, portable, and consistent. Enter metal. The Kingdom of Lydia produced the world's first standardized coins, small discs of electrum, a natural mixture of gold and silver. The idea spread like wildfire across the ancient world. Coins solved a crucial problem: trust. Stamped by a ruler, coins guaranteed their weight and purity. No need to weigh or test metal with every transaction. For the next 2,500 years, coins dominated global trade. From Roman denarii to Chinese cash coins with square holes, metallic currency became the backbone of expanding civilizations. But as trade routes grew longer and transactions larger, carrying heavy sacks of metal became impractical. Imagine buying a house and showing up with a wheelbarrow full of silver. In 7th century China, merchants began leaving their heavy coins with trusted agents who issued paper receipts. These receipts could be traded and later redeemed for the actual metal. By the 11th century, the Song dynasty formalized this system, creating the world's first government-issued paper money. Here's where things get interesting. The value wasn't in the paper itself, but in what it represented. Money became about trust and promise. I promise to pay the bearer became the backbone of modern currency. This shift from intrinsic value to representative value was revolutionary. Europe was slow to catch on. It wasn't until the 17th century that European banks and governments began issuing their own paper currencies, backed by precious metals held in vaults. For centuries, most paper money operated under a gold standard. Each note could be exchanged for a specific amount of gold. This created stability but limited how much money governments could create. Then came 1971. President Nixon announced that US dollars would no longer be convertible to gold. Money became fiat, Latin for let it be done. Its value now came purely from government decree and public trust. Central banks became the guardians of money, controlling its supply to manage inflation and economic growth. This system gave governments tremendous flexibility but led to new problems. When trust falters or too much money is created, inflation can spiral out of control, as seen in Zimbabwe's trillion-dollar notes or Venezuela's recent hyperinflation. The late 20th century brought another transformation. Money began disappearing altogether, at least physically. Credit cards invented in the 1950s allowed purchases without any cash-changing hands. By the 1990s, digital banking let us move money instantly across continents. Most of the money in our modern economy exists only as numbers in computer databases. In fact, only about 8% of the world's currency exists as physical cash today. Mobile payments took this further. In Kenya, M-Pesa transformed the economy by allowing anyone with a mobile phone to transfer money without a bank account. In China, apps like WeChat Pay and Alipay have made cash nearly obsolete in major cities. Then came 2008. The global financial crisis shook faith in traditional banking systems. In October of that year, a mysterious figure named Satoshi Nakamoto published a paper describing Bitcoin, a digital currency that needed no central authority. Unlike government-issued money, Bitcoin has a fixed supply. Only 21 million will ever exist. It uses blockchain technology, a public ledger that records all transactions across a decentralized network of computers. Bitcoin spawned thousands of alternative cryptocurrencies and tokens. Some aim to be everyday currencies, others smart contract platforms enabling decentralized applications. Together, they represent the first major challenge to state control of money in centuries. Now we're entering a new chapter: Governments are developing central bank digital currencies, digital versions of national currencies that combine cryptocurrency technology with state backing. Meanwhile, decentralized finance, or DeFi, aims to recreate financial services without intermediaries. And NFTs, non-fungible tokens, have created new forms of digital ownership. What's next? Biometric payments using your fingerprint or retina. Programmable money that can only be spent on certain items. Universal basic income delivered directly to digital wallets. The possibilities are endless. Money has evolved from shells to virtual coins, from inherent value to pure trust. Through it all, money has never been about the physical object. It's about the shared belief that it has value. As we look to the future, remember, money is one of humanity's most powerful inventions. It's the story of human cooperation written in shells, metal, paper, and now lines of code. Thanks for watching.